Welcome to the Sales Lab. My name is Anthony Grasst, host of today's program. Today's discussion is about the current health of the housing market and what the next year holds for us. Our guest today is Jeff Tucker, economist at Zillow. I'm excited to have Jeff on our program because of all the work he does studying the U.S. housing market. And today he's going to shed some light on the economic forces at work and what is going to shape the next few years for us. So Jeff, welcome to our program.
Thanks, Anthony. It's great to be here.
Yeah, welcome back. Well, as you know, the last, 2 years has just been blistering hot. We've had a very long run in the housing market. Given everything going on today, what's the overall health of our housing market right now? I mean, are we seeing cooling? Are we entering seasonality? Or are we still white hot?
Yeah. I think if we phrase it in terms of health, things were moving unhealthily fast, especially price appreciation and even the pace of sales. Homes going pending in a couple days, which forced people to take a lot of risky moves. Waiving contingencies when they're making offers. So the pace of the market has definitely pulled back a bit. It's cooled off slightly, and it's kind of returning to some of the normal seasonal patterns we would expect. Like we saw the regular seasonal buildup of inventory, where inventory bottomed out in the spring around April and actually increased like a normal summer, like it should behave, unlike the very abnormal last summer. This summer, it actually increased and it's kind of plateaued in September, which suggests that this is really returning to the normal seasonal cycle rather than maybe inventory continuing to climb. So I think this winter will look a bit more normal than last one for sure.
Well, let's hope so with that, because it has been very difficult out there on buyers with such limited inventory. Housing demand is the counter to the inventory, not the counter, but it is a contributor to the hot market. And housing demand has been really strong the past 18 months. I mean, what are the factors behind demand? I mean, what is causing such a strong surge in housing demand in our markets?
Yeah, the first place I look is demographics, because most people are buying homes not because they think it's the perfect time to buy low and sell high as an investment, but they're buying a place to live. And people tend to make that move at certain times in their lives. And coming into the pandemic, what we were focused on back, if you talked to me back in January 2020, we knew there were several million extra people entering their 30s over these few years. There's just this bumper crop of people born in 1990 plus or minus a few years. So that is a really key age range, because it's when people tend to want to get a place of their own. That's creating new households. It's when they tend to move from renting to buying. And if they're renting, if they're going to continue to rent into their late 30s, they're more likely actually to want to rent a single family home rather than an apartment in a multifamily building. This is all obviously averages and sort of like in aggregate. There are lots of exceptions. What that meant was we entered the pandemic with this huge group of people kind of poised to make one of those moves. Whether it's getting their own place, buying a home, that's what we're really talking about here. And the pandemic gave a lot of them that shove to kind of jump into the pool at this point. It gave people a reason to act now on this decision, where they may have said, yeah, I want to buy that first home maybe in the next 2 or 3 years. Well, now they needed more space. Maybe they needed, they needed a Zoom room for all their meetings now that they're doing at home. They needed a yard for all the dogs, the pandemic puppies everyone's gotten. And people saw these record low interest rates and they thought, hey, I could lock in a low monthly payment on interest for the next 30 years if I act now. And then finally, on the flip side, if people were not going into the office and they don't necessarily know what the future holds, but hopefully won't need to be, grinding it out at 7 or 8 a.m. every single day, every single workday of the year like they used to, well, then maybe they could look a little further out from the city center. So all of that gave people kind of that reason to pull the trigger now. And people actually had some more savings, between reduced expenses from not traveling or eating out, not commuting, and some of the stimulus checks. We actually saw this amazing increase in the discretionary savings rate for Americans. So a whole lot of people in this critical age range packed in some extra money and could use that for the closing costs and the down payment. beyond that, it's not just about first-time homebuyers though, and that's where I don't want to kind of fall into the trap of saying it's all explained by these 30-year-olds,
Mhm.
because a lot of those same factors impacted repeat buyers. So existing homeowners who are thinking of moving up or maybe retiring, selling that home to move closer to the grandkids or move someplace warmer with better weather. They also benefit from record low interest rates. They also benefit from, in their case, they actually benefit from the big appreciation in homes over the last several years. So their home equity has skyrocketed, which puts them in a position to often outbid
Mhm.
the first time home buyers as they're moving around. And finally, I think a lot of people went and bought that second home. So again, if you have that extra equity built up from appreciation in your first home, interest rates are low. You can now afford to go. You've got kind of the room in your monthly budget, thanks to interest rates, to buy that vacation home. And maybe that vacation home looks a lot more useful now if you could maybe work remotely a few weeks a year while you're out there, instead of only being a weekend warrior, just coming in on Friday night and having to leave Sunday night. Suddenly, that's why we've seen a huge boom in demand for vacation towns and resort towns. So this was really kind of a perfect storm of all these factors coming together this year.
Yeah, I mean, you hit it on the head in terms of increased savings. I think everybody now, of course, some people weren't able to work, but a lot of people were and were able to save. I know that my wife and I, we saved a lot of money, and then I gave it all back. I gave it back to Costco's liquor, wine, and prime meat section, as well as Amazon. But you're right. I mean, people had the money to do things, and also those. People who had owned homes for a while had built up a lot of equity, and you had the luxury of looking at a second home or looking at a move, maybe being less price sensitive, but also where the interest rates have been at historical lows, gave you incredible purchasing power. So definitely see that. I have a couple friends who are big skiers. They're now working in the Grand Targhee area and Sun Valley. So to your point, you can, if you're able to work remotely, then you can have some more flexibility. And I think that helped, that drove some markets, some secondary markets as well, because people had the ability to move around. So speaking of remote work, just give me your thoughts. Do you think remote work survives at the end of the COVID pandemic?
It's really hard to say right now. Amazingly, we're still in early days of this kind of big experiment for so many companies of letting people work remotely, work from home.
Mhm.
We know that there's a lot of demand for it. When we surveyed people who are working from home, 3/4 of them who are doing it in the pandemic would want to continue doing it at least half the time after the pandemic. And of those people who are really into it, about 2/3 of them said they would consider moving if they could work remotely. So this will really impact people's housing decisions. And yeah, I think the kind of extreme example, and frankly, it sounds awesome, the chance to just move to a ski resort town um, is fantastic. But the question here is how much of it sticks around. And I think the key factor is that more people are going to be working remotely than they used to. Not as many people as in the midst of the pandemic, but it's going to stick around more and more. And we're still kind of seeing it shake out. More employers are kind of pushing back that back to the office deadline that they set for themselves. So those have kept slipping back. Some major tech employers, in fact, are kind of uh, in a almost in a battle with their employees about it. And you know, over here at Zillow in particular, we very early in the pandemic said we're just going to be a cloud HQ. We're going to allow remote work indefinitely. And I have several colleagues who moved across the country after that point, and we've hired a whole lot of people around the country at this point. So we're locked in to the remote work model. So I think it will spread, and there's remote work, and then I think hybrid work is the other dimension to this, of people who are still going to be in the metropolitan area of their office, um, but they don't expect to come in every day of the week. We're still kind of figuring out that new model, but even that is a reason to change people's housing choices. If it's not a commute that you have to do every single day of the week, people are more willing to tolerate reaching a little bit further out. So I think some combination of hybrid and remote work is here to stay, and it's going to be a much bigger part of the workforce than it was before. How big it is still kind of anybody's guess.
Yeah, I agree with you completely. I think it's going to be hybrid. There's definitely some positives to having employees together. There's collaboration. There is, creative thought. There is culture. There's new employees, right? So how do you socialize new employees into the culture of a company when you're working remotely? My son works for a technology company around electronic signatures, and he's had to work remotely and feels disconnected from the group. On the other hand, you have many people, myself included, I've worked with the same people for 15 to 20 years. I don't need to be in the office every single day. So I think a hybrid is what we probably most likely will see. People, can come to the office, but that's a whole nother subject, because then we're also getting into how companies rethink their commercial space. So I think we're going to see continued change in this area. But, as we've said, with a change in buyers, where they can buy, how or what are you seeing at Zillow in terms of buying behavior, both online and location? What has changed or has really stood out over the last year and a half with buyers?
Well, we saw a huge shift in the industry right at the beginning of lockdowns, at kind of the beginning of the pandemic in spring 2020, when nobody quite knew whether in-person tours or open houses were allowed, to what extent, how exactly it would work. So everybody, the industry reacted incredibly quickly to adapt to this new reality of by providing tools to consumers to get a
Hmm.
lot of the experience of touring a home online. So whether that comes through 3D home tours are incredibly important.
Hmm.
Sometimes doing a FaceTime walkthrough with your agent of a home that you're considering, and consumers loved that. They loved this ability to actually see what it's like, and potentially rule out some homes that weren't quite the right fit, to really hone in on the ones that are the right fit before loading the family in the car and driving around all Sunday afternoon checking out homes. When they do that, they want it to be the leading contenders that could really be their dream home. So people are expecting more and more of the shopping experience and kind of that filtering process to happen online. And I think the agents and the brokerages that can adapt to that and are serving that need are the ones that are succeeding. That it goes all the way down to having really professional quality photography as well. And people really expect high quality, HDR photography with staged furniture to try to get a sense of the dimensions of the rooms. I think when people see kind of just sort of amateur photographs thrown up, they start to think, okay, is this in like the fixer upper category? What's going on with this house? It doesn't seem like they were thrilled to present it. And when you measure that up against the other photos and 3D tours available online, those listings are going to suffer. So absolutely, people are expecting more of this kind of digital process, and just richer information and visuals that they can get online. In terms of where people are looking, we really, it's true that we really have seen people looking more at single family homes and more at somewhat bigger homes, looking for places with a home office, looking a little bit further out from the city.
Hmm.
Um, you know, I it's yeah, we could dive into that some more too. I think this is one of the kind of the interesting stories of the pandemic. But I do think some of the early stories of urban flight, or the death of the New York and San Francisco, the death of the great American cities, I think that was overblown. But there's some truth to it, and it's also kind of just intersecting with the demographic trends we were talking about. Americans tend to move out of the central city apartments into some degree of suburban single family homes as they get into their 30s and 40s and they have kids. And that's just what this big cohort of Americans, that's the age transition they're going through. So it was kind of
Hmm.
predictable that they would be making some of these moves anyway. Maybe it's accelerated, maybe it's magnified by the pandemic effects. But there is some truth to that.
Well, yeah, I mean, there was a ton of discussion early on about everybody leaving the urban core. And, I work with a lot of condo developers in the urban settings, and we saw a lot of those projects stall. And that was for various reasons. But it appears that we are seeing demand return is movement away from the urban. Is that mutually exclusive? You can't have demand in both, or are we still seeing demand in the urban core?
Yeah, no, that's a great point. It's not a zero sum game, and it's not as if sort of the price pressure or home equity that's building up in the suburbs has to require sort of a dollar for dollar decrease in the value of real estate in the urban core.
Mhm.
Rather, this is sort of an expanding, a rising tide that is mostly lifting all boats. It's lifting a lot of kind of suburban locations a bit more, and where it's happening is
Mhm.
particularly in the most expensive metro areas in the country. Your New York, San Francisco, Boston, DC, and Seattle. These are places that kind of actually maintained this gradient of higher prices in the center and kind of falling as you go out. The classic
Mhm.
like drive till you qualify model of decreasing prices moving out from the center city. This hasn't reversed it to turn it into a big valley of despair in the middle of the city. It's more that it's just kind of flattening out that gradient. And there's even been some academic research on this that characterizes that way, kind of flattening the gradient. And really, that means the biggest price appreciation was happening in those more affordable exurban or kind of further out suburban areas. Basically, the constraint of driving commute times that used to hold those places back in terms of demand has been loosened for at least some buyers, whether it's the
Right.
flexible work or remote work. There's fewer obstacles to shopping there. But at the same time, there's just so many extra Americans trying to form households, whether it's buying a house or renting a place, that there's kind of enough demand to go around. As people sell those homes in the central city, they're not just leaving them vacant and throwing away the keys. They're selling them to someone. People are moving in to those homes at the same time. There's just a little bit less price competition and price pressure in those core areas.
Right. We're still seeing a lot of demand. We're still seeing a lot of our buyers buy in the city. And part of that too is around inventory. Where is the inventory? What can I buy? Housing inventory has been at record lows, very low, the last couple years. And now we're running into this year's supply chain issues, which has really slowed down new home construction, creating even more stress on the market. What's your forecast for inventory in the next year, and are we going to see any relief?
Not maybe a little bit. That's our forecast is that it's going to
Okay.
normalize slightly. There's been this long running debate or prediction or prophecy of a
Mhm.
wave of foreclosures or distressed or motivated sales when the forbearance programs expire. When the people who are able to get forbearance on their mortgages, giving them the option to pause payments but stay in their homes, and then work out a repayment plan later. We knew that a lot of folks were extending those, renewing them, pushing them into this fall. Um, and so some people were kind of predicting, okay, this will bring a tidal wave of inventory that was missing, and maybe it'll be very motivated sellers who have to sell in a hurry, even if they're not foreclosed for the most part, because they have so much equity that they ought not to really be underwater. They ought to be able to pay off the loan, even if
Mhm.
they've fallen behind on the payments. Um, how that's shaping up, we're at this point, we're really in the midst of when we kind of charted out the when are these forbearances going to hit their 18-month limit and expire. The most frequent dates were in September and October of this year. So to the extent that this was going to bring that some of these people were going to exit forbearance and list their home straight away, um, we must already be in the middle of that, and we aren't seeing a tidal wave of inventory. When we tried to crunch the numbers on this and consider a few scenarios, what was looking most likely is, you know, maybe as much as 200,000 extra homes could hit the market,
Mhm.
but in a setting where several hundred thousand homes sell every month, we're looking at in the ballpark of 6 million homes for the year. A couple hundred thousand extra on the supply side is not really going to tip the scales. It's not going to totally shift the supply demand imbalance at this point. I think it'll basically be absorbed. Um, Maybe I think the most we could say is that in certain metro areas, maybe in some neighborhoods that had a lot of FHA loans, where maybe a lot of people were, highly leveraged with virtually no actual equity in the home when they moved in. There could really be some people where, some of like the risk modeling suggests that there could be some kind of localized impact
Mhm.
of some neighborhoods in some cities that actually have a noticeable uptick in inventory. And those places will definitely feel a little water getting thrown on the fire of this hot market. But system wide, sort of nationwide, I don't see that happening. The other big
Yeah.
source of inventory you talked about is people building new homes. And
Mhm.
at this point, builders are firing on all cylinders. There's been almost 1.7 million permits issued in the last 12 months. That's fantastic. That's single and multifamily. Just if that sounds high. But as you said, the time to completion is stretching out further and further. So builders are working their butts off, but those windows aren't getting delivered. Those garage doors aren't showing up, and so a lot of these homes are kind of languishing in the construction process. Hopefully, some of those supply chain bottlenecks work their way out over this winter. That is kind of throttling back. I think broadly, though, that is kind of throttling back the ability of builders to meet this excess demand. And frankly, there's still so much excess demand that builders are struggling to meet it. And maybe I shouldn't say struggling. It's a good time to be a builder, but I think a lot of builders listening in on their earnings calls and things, they are frustrated that they know there's so much demand. They have so many buyers lined up, and they're unable to put the homes together and complete them on the schedule that they would have wished.
Yeah, and and I'm hoping the supply chain problems rectify itself over the coming quarter or two, so that building can resume at a normal pace. So, we work with many builders, and it is a big struggle when they have to delay the completion of a home 2, 3, 4, sometimes up to 6 months. And it's difficult. And, I joke about it, but, this is a great market that doesn't feel good. And it really is around supply chain and delivery. Another challenge we're having, not only do we have high demand and low inventory, but that combination is really creating massive price appreciation. And we're seeing it all over the place. And one thing I worry about is with rapid price appreciation, I look at who the demographics or buyers are today. And right now I'm seeing nearly 50% of the buyers. And I'm looking at our applications, in the new home side, we're seeing about 50% of buyers are under 40. And many of these are lower down, right? So they're leveraging to get into their home. Given rapid price appreciation, is affordability going to be a concern this year in your eyes?
Absolutely. In fact, I think affordability must be considered the biggest and most likely near-term headwind for the industry, particularly for sales volume.
Mhm.
I Prices are up in our index about 16% year over year. Interest rates have frankly surprised me by staying so low for so long. I thought the trend back through April in the first quarter this year was going to
Mhm.
continue. But certainly, we've still been bouncing around 3% for the rest of the year, give or take an eighth. And so I think interest rates have done all they could to make these homes affordable.
Mhm.
And in the near term, we face some risk that they're going to start working against affordability. So, um, we this yeah, I absolutely agree that the way things are going now, particularly in very expensive markets, so kind of your West Coast and California markets, we may not see that many more people who can actually who have the income to qualify at the monthly payments that will be required for these very expensive homes.
Yeah, and I wonder, I think a couple different things. One, I watched an interview by Ivy Zellman of Zellman and Associates on CNBC, and not only is it younger buyers that rising interest rates will impact, but also second homes. They had talked about rising interest rates really can dampen a second home market, which I wasn't paying attention to, but that's a potential issue too. The challenge that we have, and I discuss this a lot with builders and at different events, is simply, since 2018, all the rapid price appreciation has been offset by declining interest rates. I could actually go back and buy a home in 2018 at 4.125% interest and then buy it in 2019, 2020, and 2021 with all the price appreciation. But because the interest rates have gone down, my payment is almost the same. So it hasn't been, yes, I need a bigger down payment, but it hasn't been a big increase in payment this year now with upward pressure on interest rates. The price appreciation, it will hit the payment. And just mathematically for our audience, for every 1% the price goes up, principal and interest payment goes up roughly the same amount. So if pricing goes up 15%, principal and interest goes up 15%, but that doesn't account for any change in interest rate. So if you have both price appreciation and interest rate, it's going to disrupt the market. Now, won't stop the market because there's such demand, but it will affect it. So, Jeff, if we see affordability becoming an issue, how does that show itself in the market? I mean, outside of the obvious, what we would say, well, people say they can't afford it or whatever, but what most likely would we see in the market if affordability starts to become an issue?
Yeah, I think the first thing that will happen is that the markets around the country are going to start to diverge, where we've had kind of it's been uniformly hot around the country. Prices have been rising fast. Cincinnati, Minneapolis, Seattle, Phoenix, Dallas, you name it. What I think we'll start to see is a bit of a divergence where there isn't truly kind of a national market for housing. Some extra inventory in Maine doesn't do me any good over here in Seattle. So what we're likely to see is the markets with the highest price to income ratios, or the highest kind of monthly payment as a fraction of local area income, are going to see a slowdown. I think they're going to see sales volume slow down. They may see inventory build up a bit as a consequence. I think sellers will kind of get wrong-footed for a little while. They'll be surprised that they listed that they're not getting any bites at the price they picked. They'll have to do some price cuts. The next wave of sellers will gather that information. So we may get kind of a bit of a plateau for pricing in the priciest cities. I think that kind of affordability ceiling doesn't suggest a sharp crash in prices or a major drop in prices, but it would suggest that you kind of run out of people who can qualify, who think it's worth it to pay that much money per month. And we had a little preview of what this could look like going back to really that winter of 2018 had some ramifications into the market in 2019, where exactly these priciest markets, so San Jose, San Francisco, Seattle, we all felt a bit of a slowdown in sales volume and certainly in the price appreciation. In retrospect, and especially once we kind of got the interest rates dropped again and things picked back up, what it looked like was really kind of just a plateau between two periods of rising prices. So I think kind of a plateau in the more expensive areas, while the more affordable parts of the country could continue to see prices appreciate rapidly. In fact, even under a higher interest rate regime, because in your Indianapolis's, Columbus, Minneapolis, Dallas of the country, these are places where nobody wants to pay more for a home. But if you're another one of these 30-something millennials trying to buy their first home and get away from rising rents, get that kind of pride of ownership and ability to modify and locking in a fixed payment forever, all the reasons people want to buy that first home, it will still be attainable. They'll still be able to pencil it out, make the numbers work in markets like that. And that, especially that comparison to rents, where we're seeing a lot of rapid rent appreciation in those more affordable markets, will continue to give people a reason to say, hey, I don't love these prices, but I really want to be a homeowner. So it's just what I got to do. So they're going to jump in. That will keep prices rising in kind of the less stratospherically expensive markets outside of these kind of pricey coastal ones.
Yeah, and going back to 2018, for the listeners on today, before we hit that plateau, as Jeff said, we had 100 basis points change in borrowing rates, meaning interest rates. You could borrow at 3 1/8, and by the end of 2018, they were 4 1/8. And that year, we also had close to 11% price appreciation in some of the West Coast metros. So we definitely saw a hard stall. I called it. You called it a plateau. For my side of the tracks, I was seeing pretty much a stop in buyers, and it didn't pick up until November, late November, December, as interest rates started to go down again. So, we won't know, but you made a comment about divergent markets. In other words, there's not a uniformity there in the markets, or national theme in terms of a housing market. I'm already seeing that in my discussions with builders, and it varies all over the map. And so it might be here already. We don't know. But as interest rates increase, we need to pay attention to that to see what's going on. Another thing I wanted to cover with you, Jeff, and we had talked about it earlier, was buyer sentiment. And Fannie Mae publishes a national housing survey each month. And right now, there is a massive gap between buyer sentiment and seller sentiment. Specifically, is it a good time to buy a home? And only 28% of buyers surveyed said yes, yet 77% of sellers said it's a great time to sell. Now, this market is still hot. We still have a lot of demand. Is that a concern, or is that sentiment just simply the reality of buyers competing in a low inventory market?
Part of my reaction to that is, okay, people like me have done a good job of conveying that prices have risen astronomically. Homes are selling quickly with multiple offers. Under those, by those rubrics, these people are right. This is a tough time to buy a home. If I had a choice in the matter, and I had a time machine, sure, I'd rather be buying a home in 2012 or 2013, given these market conditions. So I think that's a pretty accurate read by the survey respondents. I sort of dug through that survey, looking at their other responses and predictions. And what's interesting is people elsewhere in the survey, they report they still do expect home prices to rise in the next 12 months. It's sort of a smaller margin than normal. People are less confident in that rise in prices. People are very confident that interest rates are going to rise in the next 12 months. So a large majority of people said that, and a large majority of people said it's a bad time to buy in the question you pointed to, which means a whole bunch of people said, answered both of those questions in the majority, which, kind of putting it together, says to me that a lot of people think this is a bad time to buy, but next year's probably a worse time to buy. And therefore, they may be, kind of reluctantly going along and buying this year. There's another question that says, if you're going to move, what, will you buy or rent your next home? It's still the vast majority of people who would say, I'd prefer to buy my next home if I was going to move right now. So that does suggest people are kind of looking around saying, geez, this is tough. It is tough out there for buyers, but if I got to make it work, if I'm going to buy under these circumstances. I think where this sentiment could really come into play more would be a bit of those kind of discretionary buyers. We've talked about second home buyers or investor buyers. Those are the folks who have a bit more of that discretion to say, oh, this feels peaky to me, or this feels too expensive, and therefore maybe I'll dial it back.
Right.
The one other factor, though, is for investors who are renting out their homes, and for people thinking of buying their first home, is what's going to happen to rent in this time period. If rent is affordable and going to stay affordable or get even cheaper, then sure, let's ride out the purchase market in the meantime. But everyone recognizes that's not the case. In fact, the rental market is heating up even faster. It's had this really rapid kind of bounce back, where as people come up for renewals on leases they signed in the pandemic, they're getting jaw-dropping rent increases. So we know the rental market is even more difficult. So I think a lot of these people may be feeling like they've got to jump out of the frying pan, even if it means jumping into the fire. If they want to get out of these pricey rentals, even if it means jumping into an expensive home that they buy.
Yeah, it'll be an interesting next 12 months here as we go into 2022 to see what happens. So with that, first of all, thank you. You've given such great insight today. I truly appreciate it. I want to get your final thoughts looking forward to next year. Give me your thoughts on interest rates. Where do you see interest rates going?
I think they've got to go up. We've got the taper, which seems really on track to start with the Fed tapering back their monthly bond purchases, which we know was included tens of billions of dollars of mortgage-backed securities. There's kind of broadly just a big picture of trying to kind of dial back the super accommodative monetary policy, and hopefully keeping this economic growth sustained, employment growth sustained. All of that would point to rising interest rates. So maybe 3.4 to 3.8% range by the end of 2022.
Okay. That's, and we believe the exact same thing, what we're seeing in the secondary market for mortgage-backed securities and demand and with tapering. I asked our secondary market person who runs our secondary marketing, what percentage of mortgage-backed securities are currently being purchased by the Fed at current interest rates, and his response was all of it. So as they begin to taper, that'll definitely put upward pressure on interest rates. What are your thoughts on price appreciation? Are we going to continue to go forward this year at 10, 15, 20% increases, or where do you think we're going to go there?
So we've already begun to see our monthly price appreciation in our main Zillow Home Value Index. It has declined for the last couple of months since peaking in the middle of the summer. So we expect that to decline, but we don't see it just sort of going into reverse. And in fact, our year ahead outlook from our August run of the forecasting model was over 11% price appreciation August to August. So I think sort of calendar year 2022, I got to get used to saying that. That's a harder number to say. Should maybe be around like the 7 to 9% range. I think we are kind of coming back down, going from pedal to the metal and letting off the gas, putting it in cruise control and kind of converging to a more kind of normal long-term pace of price appreciation. So maybe 7 to 9% next year.
Yeah, and as I said, 7 to 9% without interest rate changes people's payments roughly 7 to 9% in monthly payments. So if we have an additional 0.5% change in interest rates from where we're at right now, payments for buyers could go up as much as 13 to 15%, and their wages aren't growing that much. So that definitely puts a drag on affordability. And while that doesn't kill the market, it definitely will dampen demand and be challenging for younger buyers with their home purchasing and with qualification out there. Well, Jeff, thank you so much for being on our program today. Thank you for sharing your insights about today's market and your forecast and outlook for 2022. Great intel, great information. And for all of you listening today, I hope you found this helpful. Thank you for your being on our program today, and have a great week.